Welcome all. Happy to meet you again in a video lecture. Now let us discuss the key indicators that help an investor to analyze the true health status of an economy for taking investment decisions. There are many different tools which help us to understand the economy of a country. The tools used for economic analysis are as follows: gross domestic product, monetary policy and liquidity, inflation, interest rate, fiscal policy, impact of the monsoon, impact of war, foreign exchange reserves, public debt and the foreign debt, budget, infrastructure, government policies, taxation and balance of trade. Taxation. The level of taxation in a country has a direct effect on the economy. If tax rates are low, people have more disposable income. Also, they have an incentive to work harder and earn more, and an incentive to invest. This is good for the economy. It is interesting to note that in every economy there is a level between 35 to 55% wherein the tax collection will be the highest. While the tax rates may go up, collection will decline. This is why it has been argued that the rates in India must be lowered. In taxation, the theory of consumption plays an important role. One man's expenditure is another man's income, but all of the income is disposed of. Every man keeps some part of the income as saving. This will create reduction in income to some people. If low income people can save 10% of their income, high income people may save up to 50 to 75% of their income. To avoid a huge blockage of money, the government has to follow a progressive taxation system of high tax for higher income, say 10% tax for a people of rupees 1 lakh income and 15% for a rupees 2 lakh income, 25% of rupees 5 lakh income and so on. And this is how it has been followed, but now it is from 2.5 lakhs to 5 lakhs. Right. So there is a very new tax slab now established that less than 7 lakhs, there is actually no need of paying the income tax, just filing is more than enough. The government also encourages saving habits and attracts all the balance of unutilized money to some organized channels like bank deposits. Balance of trade. The balance of trade is the difference between the monetary value of exports and imports of the output in an economy over a certain period. It is the relationship between a nation's import and export. A favorable balance of trade is known as trade surplus when the export is more than the import, while an unfavorable balance of trade is known as trade deficit, or when the export is less than the import. Formally, it's called as a trade gap. In simple terms, balance of trade means the value of a country's export minus its imports. The types of balance of trade are the current account. The current account consists of the goods and services account, the primary income account and the secondary income account. The capital account. The capital account is much smaller than the other two and consists primarily of debt forgiveness and assets from migrants coming to or leaving the country. The financial account. The financial account consists of an asset inflows and outflows such as international purchases of stocks, bonds and real estates. When exports and imports are in balance or equal, we have a balance of trade. But developing nations like India suffer from an unequal balance of trade. Advanced countries export technology goods like computers, satellites, radars, aircrafts, warships, engineering machineries, and the cost of these goods is very high. Developing nations export agricultural goods, coffee, tea, textiles, etc., which have low money value when compared to the technology goods. After 1990, India adopted a liberal economic policy and started producing various technology goods with the utilization of high foreign investment and started moving towards becoming as a major power. Impact of war. A war always shows a negative effect on the economy with a decrease in money value, profits, etc. A war is always bad for any economy, and it does not matter whether it is a superpower economy or a growing one. The post-war inflation is always high. Taxes go up to make up for the government expenditure. The purchasing power of the people is reduced and the aggregate demand also declines, so that the company profits become low. Investors loses and therefore heavy. Foreign exchange reserve. Foreign exchange reserve is greater than the trade with foreign countries, the better is the exchange of the currency between various nations, and this reflects on the country's image. In 1991, a new economic policy was introduced in India. A lot of foreign investment were invited instead of high loans and increasing interest burdens. After the new policy came into effect, the country's foreign exchange reserves or the currency reserves shot up to the high levels, and this brought about a massive turnaround in the economy. The Indian stock market improved and the number of companies listed in BSE and NSE rose substantially. Public and foreign debt. Public debt seems high in Indian companies compared to the advanced countries. In India, the money market development is relatively poor and there is less liquidity for sale of debt instruments. Now, the Indian government has introduced development finance institutions such as ICICI, IDBI, IFCI, etc. These are directly controlled by the Ministry of Finance. The above debt instruments are easily saleable with the stock exchanges, and also one can enjoy high security in investing in the bonds of such development finance institutions. Budget. The stock market's working is highly dependent on budgeting. At the time of Union Budget, the stock market sees a bit of swing because there are high expectations, and if the budget is not up to these expectations, it results into a steep fall in the stock market. For example, in July 2009, on the eve of the budget, stock prices slumped by nearly 2% as investors were nervous about the budgetary support. Infrastructure. The development of an economy is dependent on its infrastructure. Industry needs electricity to manufacture and roads to transport the goods. Bad infrastructure leads to inefficiencies, poor productivity, wastage, and delays. This is possibly the reason why recent budgets lay so much emphasis and offer so many benefits to infrastructural industries such as power and transportation. Flyovers have been built, national highways are being widened and made better, and improvements made in the communication to the larger reach out to the larger masses. Government expenditure. The government policy has a direct impact on the economy. A government head that is perceived to be pro-industry will attract more investments. The liberalization policies of the Narasimha Rao government excited the development world, and the foreign companies have since then shown keen interest to invest in India. The initiative of the BJP government in improving the infrastructure grabbed the attention of foreign investors. The present government continues to focus on infrastructure, as it has to be realized that the progress at a decent rate is not possible without infrastructure. Before the new norms in 1991, the government was keeping its doors closed for outsiders, but the new reforms increased the holding by up to 50%. Interest rate. Interest rate plays a vital role in terms of understanding an economy. If the interest rate is low, it stimulates the investment in the economy. Low interest rate leads to higher number of investment because the return on investment will be high. Whereas if the interest rate is high, it will show a reverse picture because it leads to higher cost of production and less spending. When there is an increase in interest rate, it leads to a decline in the bond price, which in turn lead to fall in the stock prices. When the interest rate rises, the investors' required rate of return on the shares rise as well, causing the prices of securities to fall. The rising interest rates also make the bond yields look more attractive in relation to share dividend yields. Foreign investment. When the economy grows at a faster rate, it requires more investment when the domestic sources like banks and other investors cannot serve the rising demand. At this juncture, the government encourages the foreign investments, which can be in two forms, that is, foreign direct investment FDI and foreign institutional investments FII. FDI is allowed for all business ventures, whereas FII is limited to the investment in financial instruments and markets. When the foreign investment is high, it indicates healthy prospects in terms of the economic development of the country. Impact of monsoon. Monsoon plays a vital role in economy. There is a direct relation of monsoon to the stock market. When there is a good monsoon in the country, the Sensex also sets a new high and vice versa. The impact of monsoon is more pronounced on the agro industries, fertilizers, pesticides, seeds and edible oil. Subsequently, the demand for other manufacturers' goods also goes up. Gross domestic product GDP. It is a measure of economic activity. This is the total amount of goods and services produced in a country in a year. It is calculated by adding the final value of all goods and services produced in a year. GDP has several components. Some of the major components are as follows. Consumption spending. It represents the production of those domestic goods and services which are consumed by the public. Investment spending. It represents using capital for future productive purposes. Government expenditure. It consists of spending of the central state governments, state governments and the local governments on goods and services such as infrastructure, research, roads, defense, schools, police and the fire departments. This does not include the amount spent in the form of relief or compensation, since they do not represent production of goods and services. Monetary policy and liquidity. A good monetary policy and liquidity is essential for the economy, since excess liquidity can be harmful. Excess liquidity leads to inflation, higher interest rate and costly sources of capital, and it ultimately slows down the growth. Money supply can be measured through M1, M2 and M3. M1 is the amount of money in circulation, demand deposits and the traveler's check. M2 is M1 plus small time and savings deposits. M3 measures the money supply that includes M2 plus large time deposits, repos at commercial banks and the institutional money market accounts. A steep rise in BSE index is accompanied by a corresponding rise in M1 and M3. Inflation. Inflation has numerous effects on the country's economy. It is of significance in relation to the stock market too. Before going into the effects of inflation on the country's economy, let us be clear with the meaning of inflation. The term inflation means the rate at which the price of goods and the service increases in an economy. When there is a rise of inflation, the purchasing power of individual decreases. The price indices widely used for this are Consumer Price Index, adopted by countries such as USA, UK, Japan and China, and the Wholesale Price Index, adopted by countries such as India. Thus, the inflation rate generally is derived from CPI or WPI. A constant inflationary situation will be foreseen as a positive influence on the investors, and hence the market prices are likely to go up under such circumstances. Thank you. Hope the session was informative.